Hello everyone, this video is part of the BearNBull feature series. We're going to talk about target allocation. Specifically, how do we optimize the target allocation of our portfolio? This is one of my favorite features and I'm excited to show you what it's all about. I'm here at a portfolio page. This is a model portfolio called BNB Invest that has US stocks, ETFs, and crypto. I'm going to scroll down to the table section. First table we see here is the holdings table that lists all the assets we have on the portfolio, also the current weight distribution, current value distribution, and this is based on all the transactions we've added. But I'm gonna jump to the targets table, and here is where we set target weights for our portfolio. We do have another video specifically on setting target weights and calculating the expected return and risk for the portfolio. Make sure to check that out before proceeding with this video. All right, all the information here, just as a reminder, has been calculated based on a historical period that we set at the bottom of this table here. We set a start date, end date, and here we have more or less 5 years of data. You could increase it up to 10 years, do a little bit less span of time. You can do your own sensitivity analysis, but I'm going to keep it at 5 years for demonstration purposes. I also like to visualize all this information on a graph. So I'm going to scroll up to the graph section and I'm going to click on the risk return graph. And here we can see all the assets in the scatter plot. Y-axis is the expected return, x-axis is the expected risk, and the blue dots are all the assets. If I hover over, I can see the return risk metric. The red dot is our portfolio where we currently stand. And currently we have the portfolio sitting with 100% of its weight on the VOO ETF. This is a Vanguard S&P 500 ETF. And let's imagine that we decided to add some US equity, some stocks that we researched, did our fundamental analysis, and think these are solid companies. And I selected 10 of these companies here diversified across sector. Just as a side note, BearNBull has amazing asset research features. So you can go there and check it out to do your own research. Going back here to the table, one of the strategies, so the big question here is how, now that we selected all these assets, is how do we allocate the weights to all these assets? Well, one option is, let's say we're very bullish on Ford and we want to go all in, put all our bets here and put 100% of our money here. So I'm going to add 100 at Ford. I'm going to zero the weight here for the VOO ETF. And I'm going to recalculate the portfolio expected return and risk. Once the process finishes, we should see that now we have a higher expected return, higher risk also. If we move up to the graph, we can see that that red dot that was sitting on top of VOO, it moved to where the Ford stock sits. The issue with this strategy is obviously diversification because we're taking too much specific company and sector risk, also known as idiosyncratic risk. It would be nice to have a measurement, a metric that tells us how much of that risk we're taking. And this is really easy to see at the portfolio page here. If you scroll up, this metric is so important that we put on the top right corner here of the page. So you can see the 45% metric. And this is the diversification versus the total US equity market. It's in red because it's very low. Obviously, we're taking too much specific risk. So you could say potentially maybe another company that is bigger, more diversified. Let's say Apple could be a better bet since it's about 7% of the S&P. And we can try that out just to see the differences. I'm going to recalculate, go back up. The red dot for the portfolio is going to move all the way up to Apple. And what happens when we see the diversification level, yes, it went up a bit. We're on the yellow zone here, but it's not that much better. So we could do better. For example, obviously, if we go back to 100% of the weight on the S&P 500 and recalculate, we can see that our diversification now is at 99%. So this is pretty well diversified strategy. I'm going to use this portfolio with 100% on S&P 500 as our baseline. And I want to make sure I record a copy of this portfolio state here for comparison purposes. The way to do that is we jump to the snapshots table. And here we can take snapshots of our portfolio. So I'm going to say, give it a name. Say it's 100% VOO, which is S&P 500. And I'm going to submit. And now we have a copy that we can always roll back to. And we can also check this box here to make it show on our risk return graph. Going back to the targets table now, a better strategy would be to include a lot of these companies here. As we add more assets to our portfolio, which are less correlated to the portfolio, we increase the diversification level. We do have on the graph side a correlation matrix here that helps us visualize the level of the correlation amongst all these assets. So if we hover over the graph, we can see what type of correlation they hold and if adding them would benefit the diversification of the portfolio. Going back to risk return here. And so I'm going to use a simple strategy, which is adding equal weights to all the US stocks here. Since we have 10 of them, I'm just going to add 10% to all. I'm not going to do anything with the bond ETF now. I'm just going to focus on the US companies. I'm not going to add the crypto either. And now we should have 100% weight again, so I can recalculate. And we can see back on the graph that the red dot, here's the snapshot we took. It's kind of faded red. That it increased in terms of expected return, but it also increased the risk. I'm going to say we want to keep the level of risk more or less in line with what the S&P 500 gives us. So one way we can balance that risk is we could add some weight to a risk-free asset. I do have here an ETF called SHV, which is very low risk because it holds short-term US treasuries. So we could use this ETF to balance the risk level. So I'm going to take some of the weight out of all the assets, still keeping equal weight to all of them, and add some weight to that risk, close to risk-free asset. So instead of 10%, I'm going to go with 9%. and the remaining weight, the 10% remaining, I'm going to add to the SHV asset. Recalculate, and now we should have a portfolio that is more in line in terms of risk with the S&P 500. Here we get 21.34%, and this portfolio is at 21.17, so pretty close. But the good thing is the expected return is higher, which is very nice. So I like what we have here. I'm going to take another snapshot to record this state. I'm going to say this is the equal weights portfolio. And now we have two states that we like here. But the question is, can we do better? Well, we could try all the different combinations of weights for these assets, but it would take us a long time to do that work. Luckily, we have math to help us, so we could use quadratic programming to calculate all the most efficient portfolios when combining all these assets. So BearNBull makes it really simple to do that. I'm going back to the targets table here, and we can use the optimize button here to generate an efficient frontier of portfolios. I'm gonna do just that. So clicking on the optimization link, the process starts. And when I go back to the graph, now I have a green line which holds all the different combination portfolios that are more efficient. You can see that there's a significant increase from where our portfolio sits to what it's possible along this line. And I can just hover over the line to see the different portfolios in terms of return and risk along this line. And one of the really neat things we could do is we could select a portfolio that is about the same level of risk that we're targeting and click on this line. A new process starts, and once completed, now we have our portfolio sitting on that line. So if we go back to the targets table, we can see that all the target weights were calculated to match that portfolio. This is really nice because this portfolio can give us a much higher expected return for a similar level of risk. There's just one little problem. It seems like we have a lot of weight on just a few assets here. So, and we zeroed the weights on a lot of the other assets. So it's expected that we lost some of the diversification aspect of the portfolio. And we can confirm here, going up on the upper right corner here, that we're now at 71% diversification. We're back to the yellow zone. So that it is interesting, but it's not ideal. Either way, I'm gonna take another snapshot here and I'm gonna say this is the optimized portfolio, and I'm gonna say not diversified. And so we have a copy of this option here. And so how could we achieve a better result than the equal weight portfolio, but also keeping our portfolio at a nice diversified level? We do have the option to set minimum and maximum weights. And this is what I'll do. We can set it individually for all these assets, but I'm going to set for all of them at the same time on this first input field here. I'm going to say we need at least 5% allocated to these assets and a maximum of 15%. And I'm gonna just leave crypto for now out of the equation. So I'm gonna zero the minimum and maximum here so we don't affect our optimization with the crypto assets. And I'm gonna hit optimize again. And when I look up on the graph side, we'll see that a new efficient frontier was generated. It is much smaller because I limited the amount of options and portfolio possibilities by giving all the assets a minimum and maximum boundary, minimum and maximum weights. But still, what we can see here is that there is one option with similar level of risk that gives us a higher expected return than the equal weights portfolio. And to get there, I'm going to click again on the efficient frontier. A new calculating process begins. The portfolio now is updated to that point on the efficient frontier. And if I go down to the targets table, I'll see that all the weights were updated. Some assets will have more weight than the others, but most of them will have at least the 5% that I set as a minimum boundary, or a maximum of 15% that I set as a maximum boundary. And this should give us the diversification level that is acceptable. And the answer is yes, we're back on the blue zone here in terms of diversification. So I like this, and I'm going to take another snapshot. So this is the optimized, diversified portfolio. And I'm going to click on the checkbox here just to show all these different options here on the graph. And you can see how easy it is to understand the different levels of risk of these assets and the portfolios that we iterated through, and the expected return that is possible with all these target portfolio options. I really enjoy this feature, and I use it all the time when I'm rebalancing my portfolio. I hope you enjoyed this video. If you have questions, just send us a note.